Welcome to the Deep Dive. We take stacks of information, break them down, and pull out those really crucial nuggets of knowledge.
We do.
Today we're diving into something pretty fascinating, actually. It's a great case study in, well, market psychology, really. Gartner's Q2 2025 earnings.
Yes, Gartner, the big IT research and advisory firm. We're talk tickers, and our job is basically to shortcut you to understanding what's really driving things after these earnings calls.
Exactly. And this call, it happened pre-market August 5th. Highly anticipated.
Oh, definitely. It gave us a really critical look into how enterprise spending is shifting. I mean, the economic landscape is complex right now.
Cautious.
Yeah, cautious is a good word. So we'll connect the dots, right, between the numbers they reported, what management actually said, and, the wider implications for tech, for advisory. Our goal today is simple. Get you properly informed on this update. Pull out the facts, sure, but also the surprises, the aha moments, so you get what's really going on behind those headlines. Yeah, I mean, think about it. How does a company beat earnings, show strong cash flow, and still see its stock take a hit?
Right. Gartner's call is a perfect example. It's a story worth digging into.
Okay, so let's start with those headline numbers. Gartner's Q2.
All right. Adjusted earnings per share, they reported $3.53. Now, that beat the consensus, which was $3.30. So a solid 7% beat there.
Not bad on the surface.
And revenue, $1.686 billion. That just nudged past the $1.68 billion consensus. Year-over-year growth was 5.7%.
Or 4.6% if you look at it FX neutral, taking currency swings out of the equation, which gives you a better sense of the core business performance.
Good point. So beats on top and bottom line. It sounds positive, right?
You'd think so. But the immediate market reaction, it told a very different story, a clear disappointment.
So investors weren't looking at the rearview mirror?
Not at all. The focus snapped immediately to, forward-looking stuff, key indicators, and really critically, management's updated guidance for the full year.
The guidance.
Yeah, and contract value, which is, super important for a subscription business like this, it grew 4.9% FX neutral, hit $5 billion.
Okay, so growth, but maybe not the rate of growth the market wanted.
Exactly. The rate was the sticking point. So yeah, solid execution on the quarter itself, but there's clearly a deeper story the market latched onto.
Okay, so let's unpack that. What exactly spooked investors, even with those decent current results?
Right. Because beyond the headlines, the financial health actually looked pretty robust. Adjusted EBITDA, for example, $443 million. That's up 6.6%.
Healthy.
And cash generation was strong, too. Free cash flow, $347 million. Operating cash flow of $384 million. The underlying engine is running well.
And they seem confident, right? Look at the shareholder returns.
That's fascinating, isn't it? Even in this cautious environment, they bought back 0.7 million shares in Q2 alone, spent $274 million doing it.
And then they boosted the buyback authorization.
Yeah, another $700 million. So year to date, they've repurchased around $720 million worth of stock.
Wow. That does signal belief in their own value, doesn't it? Management basically saying, we think the stock's cheap, putting their money where their mouth is.
Precisely. It's a vote of confidence in that cash generation, even with the economic shifts. But here's where it gets really interesting. The why behind the market reaction. It's the macro story.
Okay.
CEO Gene Hall, he highlighted a really significant shift, almost palpable, you could say, in how the C-suite is thinking. He said 78% of execs they surveyed are actively cutting costs.
78%.
Yeah. This isn't just, trimming the fat. It's like a recession-level caution spreading.
That really paints a picture. It sounds like companies are scrutinizing every single dollar now.
They are. And Hall also mentioned purchase decisions, even small ones, are getting escalated. CFO level, sometimes even the CEO.
Which just grinds everything slower. Lengthens the sales cycles dramatically. We've seen that before in downturns. Adds layers of approval. A friction.
Exactly. So the natural question is, what specific headwinds are causing this? For Gartner specifically, management pointed to two big things.
Okay, what were they?
First, the U.S. federal government. Initiatives from something called the Department of Government Efficiency apparently made it much harder for federal clients to buy or renew.
How much harder?
Get this. The year-to-date dollar retention rate in that segment was only about 47%.
47%. Ouch. Less than half the dollars retained. That's brutal.
It really is. And that federal contract value is currently around $200 million. So a significant impact there.
Okay, so the government piece was one major factor. What was the second?
Tariffs. They're playing a bigger role than maybe people expected. Management figures about 35% to 40% of their contract value.
Across both tech sales and business sales.
Yep, across both global technology sales and global business sales segments, is tied to industries feeling the pinch from tariffs.
And these companies are worried about profits, so they cut costs aggressively.
Exactly. Even if they aren't directly hit themselves, the worry is enough. It creates this ripple effect. They start acting like they're in a recession, tightening those purse strings.
So tough environment, government hurdles, tariff worries.
Yeah.
But it sounds like Gartner isn't just, sitting back and waiting. What are they doing strategically?
No, they're definitely adapting, innovating, actually. A key thing they highlighted was the rollout of AskGartner.
Ah, yes, their AI tool.
Right, their own in-house AI-powered insight tool. And this is important. It's grounded only in Gartner's own proprietary research, not scraping the public internet.
Which is a key differentiator.
Huge. The goal is deeper client engagement, obviously expanding wallet share by making the research more actionable, easier to use, reducing friction.
And clients seem to like it.
Oh, yeah. Pilot clients called it a game changer. Some reported saving up to 75% of their time on the platform.
75% time savings. That's massive value.
Incredible, right? So the plan is to roll this out fast. Thousands of clients per month. Get it to all licensed users by year end. It's a big strategic bet on leveraging their unique data moat.
That really could change how clients interact with them, making that vast knowledge base much more accessible, getting the right answer fast from a source they trust.
And they're not just using AI externally.
Right. They mentioned internal use too.
Yeah, walking the talk. Over 50 internal AI applications aimed at boosting their own associate productivity.
Makes sense.
And one other subtle thing, but telling, they renamed their main research segment. It's now Business and Technology Insights.
Okay, why is that significant?
Well, it's not just marketing speak, I don't think. It signals this shift, right, from just providing research reports to being more of a partner, helping businesses navigate these complex, long-term strategic challenges. It's about showing that tangible value, staying essential.
So lots of strategic moves, strong underlying financials. But despite all that, the big news, the market-moving news, was still the guidance cut, wasn't it?
Absolutely. That was the main driver of the stock reaction. Consolidated revenue guidance for the full year lowered to at least $6.45 billion. That was down from $6.54 billion previously.
And profit margin guidance?
That actually stayed the same. Adjusted EBITDA margin guidance held at 23.5%, which, shows they're managing costs tightly, protecting profitability.
Right.
But that revenue adjustment, that's what hit hard. It told investors the near term is just tougher than they thought a few months ago.
So given those headwinds, the guidance cut, how realistic is this path back to double-digit growth they talked about by 2027?
Yeah, that's the million-dollar question, isn't it? Management laid out a roadmap. They see contract value growth improving, low to mid-single digits by end of this year, 2025.
That's accelerating.
Accelerating to high single-digit growth in 2026, and then crossing into double digits in 2027 and beyond.
But that depends on a few things falling into place, right?
Oh, absolutely. It's predicated on, well, first, those specific U.S. federal government headwinds easing up, the ones related to that Department of Government Efficiency. Second, more clarity, more stability in those tariff-impacted industries. And third, crucially, a continued rebound in broader tech vendor spending. If those external factors don't improve, that path gets a lot steeper.
And internally, what levers are they pulling?
They're doubling down on operations. The AskGartner rollout is a big piece of that engagement strategy, plus focusing more on providing cost optimization insights.
Which is exactly what CEOs want right now.
Ironically, yes. They also talked up their sales force, about 5,000 quota-bearing reps. They think there's significant productivity upside there.
That headcount is staying flat this year.
Relatively flat in 2025, yeah, navigating the current job. But the plan is to reaccelerate hiring those quota-bearing folks in 2026 and 2027.
So positioning for the recovery.
Exactly. Capturing that big addressable market they see. Optimizing the sales force for growth when it returns.
Okay, so connecting all these dots, it seems really clear the market just zeroed in on that slowing contract growth and the guidance cut.
Totally fixated. Almost ignored the earnings beat, the strong free cash flow.
And it fits this broader pattern we're seeing, right? Tighter enterprise tech budgets everywhere, even with all the Gen AI hype vendors are pushing.
It's definitely a challenging environment. And, Gartner usually has strong pricing power because of its research franchise. That's a big plus. But near-term demand. Cyclically soft, no doubt.
And the stock performance reflects that softness.
Oh, big time. Total return down nearly 16% in the past month. Year to date, down almost 50%.
Wow, 50%. Massively underperforming the S&P 500, the tech ETFs.
Significantly. And the sell-side analysts, they quickly started talking about visibility haze.
Meaning uncertainty.
Yeah, basically saying it's hard to predict near-term revenue, so they adjusted price targets down, mostly staying neutral for now, though, waiting and seeing.
So it really highlights that classic conflict, doesn't it? Solid execution, running smack into weaker demand.
Absolutely. Investors are clearly questioning that near-term visibility, the speed of the recovery for Gartner's main businesses, and that's led to this, well, pretty major repricing of the stock. It's all about how quickly you think those macro tides will turn.
All right, this is the part where we absolutely have to remind you, nothing we discuss here constitutes financial advice.
Yeah.
Always, always do your own rigorous homework.
Definitely. We're here to break down the information, not tell you what trades to make.
If you are looking for an outrageous, maybe plausible trade idea to chew on.
Okay, here's one to mull over. Given Gartner's huge underperformance this year, right, compared to the market, compared to tech.
Down nearly 50%, yeah.
And combine that with management laying out that specific path back to double-digit growth,
Right.
driven by things like AskGartner, their unique AI, and assuming those headwinds, the federal spending, the tariffs, eventually normalize.
Okay.
Well, a long position in Gartner could be, let's say, intriguing.
How would you structure that? Common stock.
Oh, yeah.
Option.
Could be common stock. Or maybe long-dated call options if you want more leverage. That gives you the right to buy later at a set price.
And you might pair that with something.
Potentially. You could pair that long Gartner position with a short position in a broad tech ETF.
So expressing conviction specifically in Gartner relative to the sector.
Exactly. It's a bet that Gartner, despite the current pain, has unique stuff, proprietary insights, strategic moves like AskGartner that could let it seriously outperform the general tech pack once these macro pressures ease up.
So it's a bet on their specific execution, that multi-year plan, overcoming these temporary, albeit painful, external factors.
That's the idea. Outrageous, but plausible. Food for thought.
Okay, so let's wrap this deep dive on Gartner's Q2 2025. We saw resilient financials underneath.
But big macro headwinds, specific challenges too, U.S. federal tariffs leading to that trimmed revenue outlook for the year.
Right, and the company's adapting, making crucial moves, especially with AskGartner.
And they have that clear plan, that roadmap, aiming for double-digit growth again by 2027. The market's reaction, though, really hammered home its focus on the near-term visibility worries over those longer-term plans and the strong cash flow.
So as you process all this, maybe ask yourself, how temporary are these headwinds really? Can they dissipate quickly?
And will Gartner's AI investments, especially AskGartner, actually accelerate that return to growth? Could the market's initial reaction prove, overly pessimistic in the long run?
That's a great question to ponder. Really captures the dilemma for investors right now. Okay, thank you for joining us for this deep dive.